Good morning. I'm Christy Duffy for Smart Trend News. Today is Monday, June 14th. Last week, major U.S. stock indexes closed higher despite poor U.S. jobs and retail data. Germany was in the spotlight as the German Constitutional Court reviewed the legality of German payments to the EU debt. And China showed better than expected export data. So what will be the market moving news for this week? With me to discuss is Cliff Wachtell, Chief Analyst for AvaFX and a financial blogger for SeekingAlpha.com. Cliff, good morning.
Good morning, Christy.
Thank you so much for taking the time to speak with us this morning. So what is your overall outlook for the coming week?
Okay. We're looking at a real probability of getting some kind of reaction bounce. This is not uncommon. Matter of fact, this is rather typical when we're looking at a long-term downtrend. Nothing goes down, straight down. It's normal to get oscillations within the downward movement, and this is what we're seeing right now. We've got, as I've spoken about, when markets get very oversold, even mildly positive news can be enough to get those people who just came in who just shorted the market. They haven't booked a lot of profit, and so if they start to see any kind of rally, they're very quick to close out those short positions, which means they're buying back the market, they're going long, and that starts a cascading movement of people starting to go long the market, what's known as a short squeeze. And that can build its own kind of momentum. So there's a real chance, given that on Friday, and Friday is a classic take profits day, if people were willing to go long into that market, there's a really good chance that we could get a multi-day bounce here.
Great. So what are going to be the key events to look for this week that will influence how the markets fare?
Okay. In terms of the economic calendar, it's a fairly light week. We have a few things. We have some inflation data coming out for UK and also for the US. That would be very important because right now the central banks have no motivation to raise interest rates at all. Jobs are struggling, spending is struggling. The UK, however, has already had inflation numbers higher than they want, and that could raise the prospect of interest rates being raised there a little sooner than possible. We'll be waiting especially for inflation figures for the US, because if inflation starts to look like it's becoming a problem, that is suddenly lights a fire under the Fed to start considering raising rates, start tightening up on the loose money earlier than they might otherwise want to do, which would of course be great for the dollar, bad for stocks and most risk assets.
As you mentioned in some of your articles, last week was the first week in a while that no negative news came out of the EU debt crisis story. And have the markets been overly negative about Europe, would you say?
I don't think so. The Eurozone, this is not new. I mean, many people have pointed this out for years, has some really fundamental problems. I mean, imagine you've got a family where there's one budget, but everyone's sort of free to spend what they want. And so you've got some that are a little more responsible about that than others. That's a fundamental contradiction. You've got independence in spending and yet a unified currency. So as we've seen, even a relatively small country like Greece can literally threaten to pull down the whole house of cards. So this is a real problem. The markets may be a little bit overly negative in the short term, which is why, again, they're prone to take some kind of bounce. We didn't, as you say, we didn't have any negative news this week on the euro. That's the first time we've had that, I think, since early May, if not earlier, which is why we got one of the reasons we got a positive close this week for the first time since early May. In addition, we had some positive data. We had blowout numbers for China's exports showing that they're not getting affected too badly, and everyone's depending on China as one of the major growth engines. The US had some mildly positive data. We had some positive comments from Fed head Bernanke, from the ECB head Trichet, from New Zealand bank head Bullard. All of this came together, and market, everyone had been waiting for this balance. They knew, well, at some point. And now that gave it sort of the green light. And once it starts, again, those short sellers have to start, who are late to the party, have to start closing out positions, which gets the markets moving up, and that causes other short sellers to come in. And once and then of course we've got the computer programs that are watching who have their own, and these have their own ideas about when there's enough momentum to start going long. If you look, for example, at the euro-yen currency pair, the S&P has followed that very, very closely, really suggesting very strongly that the computer programs, the algorithms are kicking in. And once that gets started, we've got some upward momentum, which feeds that short squeeze buying, which feeds the computer program buying. And as I've mentioned, however, the easy gains are now over. And the S&P, which is my favorite picture overall of risk sentiment, that's now gotten right up to that zone where we're looking at 4 or 5 different kinds of really heavy resistance. And that's where we're going to see if this move has any kind of legs, and if it can last through the week, or if it's going to fizzle much more quickly. Because most everyone believes it's a temporary move, but still, it's a tradable move for the short-term trader.
All right, for a little bit more on economic events, I know you mentioned this a little bit already. However, Consumer Price Index, as well as the TIC report and housing data is all due out this week in the U.S. Can you give us any kind of a forecast for the expected results of these reports and their impact?
I don't have the figures in front of me, so I can't speak to specifically what the forecast is. Housing, we all know for the longer term, is a huge problem. I've seen some very good studies suggesting that the U.S. could be looking at something as much as a 10-year overhang. Opinions vary somewhat, but it's very clear that U.S. housing is still very, very troubled. And if there's anything that really threatens the U.S. market right now, it's housing, because those mortgages, as more and more people are now underwater with their mortgages, and these are non-recourse loans, there's more and more of a temptation to let those mortgages go and just default. And if that happens, that's huge trouble for the banks. And do keep in mind that the banks have been central to the market movements over the past couple of years. The entire crisis that we're in right now, that began with what was supposedly a very containable subprime crisis in the banks, that metastasized into a global crisis, and we all learned about what contagion meant and how quickly one bank's problems could become systemic, that is literally threatening the entire system. So the banks are very, very critical to watch. Housing data is very, very critical to watch. Not any one given number, but the trend as it's going forward. And there are some significant problems with that. As I said, CPI is going to be a carefully watched figure this week. It's a light data week, but the CPI is going to be very important for giving us some idea if the Fed is moving closer to tightening or not. Because inflation right now is the only thing that could get them moving faster than they want to go. They want to keep the money flowing, and so that jobs can recover, so that consumer spending can recover. Consumer spending, it's about 70% of the U.S. GDP. So those are very, very critical metrics that the Fed is looking at. The big events, though, the things that are really likely to move markets are not probably going to be the economic events, but what new surprises do we get out of the EU or from China data? We have suspicions about a bubble going on there. So far, China's like a speeding train, nothing's stopping. As I said, 50% growth in exports, which were well above what expectations were. So it's going to come from the big market-moving events. Keep your eye on China, on China. Keep your eye on the EU. Threats to government stability. Angela Merkel in Germany has already lost control of her upper house. Both debtor and donor nation populations are not happy about what's going on. What's happened to the euro is is a German citizen's worst nightmare. They were hoping to get a pan-European Deutschmark, a solid currency, and what they see happening before their eyes is watching their hard-earned savings turned into the equivalent of a pan-European drachma. It's going to be very interesting to see. I really question if the countries long term are going to have the staying power, or if populations are simply going to throw up their hands and say, you know, let's bail out our banks. At least we know what the rough final bill on that is. Keep in mind, markets are still pricing in something like a 70% chance that Greece goes belly up in the next 5 years. What the big EU IMF package has done is it's bought time, nothing more. And that's important too. Rather than have the patient die on the table, leaders have some time to figure something out. But that's all it is.
And by donor nations, of course, you mean Germany, and by debtor, we know you mean Greece. But as for other debt nations, who else should we be looking out for and looking for warning signals from?
All right, meaning besides the ones that have already been in the spotlight?
Yes.
Okay. Well, we already saw last week, Hungary in time-honored tradition said, hey, that last administration, they really left us with a mess. We could be in trouble. Now, granted, there's a certain amount of politicking there. They were preparing their own populations for taking some pain. But that doesn't mean the problems aren't any less real. Bulgaria and Romania share issues. Keep in mind, they're, according to the CDS swaps, that those are basically insurance costs. The difference between insuring Romanian or Bulgarian bonds versus those of insuring German, very safe bonds, those are lower now than those of Turkey and Peru. So the market has some very real concerns about Romania and Bulgaria. And this is a real problem because Austrian banks and Greek banks have a lot of exposure there. Greece and if they wind up tipping Greece over, then Portugal is almost sure to go, because Greece, and so on, it goes. And even if you want to argue, no, there'll be enough money there, nobody really knows in the end who's exposed to what, and it's that uncertainty that is the thing that can kill markets. It's that freezes up bank lending when banks stop lending to each other, and it's when you get those credit freeze-ups, that's when things get very hairy. Because businesses and banks that are depending on being able to get overnight loans at a certain cost and suddenly can't, and find themselves suddenly the next morning, oh, no money. And that's the thing. It's the uncertainty that's killing the markets right now. And until we get some kind of clear picture of who is exactly in debt to whom and what the exposure is to whom, and we're not getting it anytime soon, that's the wild card for the markets. Because if there's any uncertainty, markets freeze up. Bank lending stops, markets sell off.
Well, the debt crisis will certainly be in the forefront this week, probably for the next few weeks to come. And I know we still have several weeks still till earnings season officially kicks off. However, there are some companies reporting earnings this week. Are there any major names you're looking at?
Not the really marquee numbers. Traditionally, we start. Earnings season really moves into the spotlight in about another month, with Alcoa traditionally kicking that off. We have gotten some warnings that there will be pre-announcements that will be trying to lower expectations because a lot of the earnings may not be as good as anticipated. Because again, markets have been looking for not just improvements in earnings, but they want to see top-line organic growth, not just improvements from spending cuts, because everyone knows those aren't sustainable. What we always want to be keeping our eyes on are the banks. Again, they're the ones that led us into the crisis with the subprime mess. They're the ones that led us into the rally that began in early March of 2009 when we started to see some improving numbers there. Say what you want about how real those were, but the banks are critical. They're the ones that have to survive. They're the one, it's keeping them liquid and keeping that heart of the financial system beating. That's what's behind all the bailouts. It's not that we're really worried about Greece and Portugal. It's the fact that German and French banks are the ones holding this debt. And who knows how much in terms of derivatives alone, what the real exposure is, that not everyone is even sure about. So we're not likely to get really big name earnings announcements. We may get some warnings. Certainly going about 2 weeks from now, when we start to get more of that earnings starts to get into focus. Again, watch the banks, watch the big, the bellwether marquee name, leaders in the various sectors. Banking and tech are the things, of course, that we really, really want.
All right, well, thank you so much, Cliff, for all your great insight and taking the time to fill us in this morning for the week ahead. Cliff Wachtel is the chief analyst for AvaFX and a financial blogger for SeekingAlpha.com. Cliff, is there anything else that you'd like to mention where we can find some of your work?
Sure. Simply at fxmarketanalysis.wordpress.com, or if you simply go to avafx.com, that's Alpha Victor Alpha Foxtrot Xavier, go to resources and you'll find a picture of me there. We specialize in making it very easy. The Forex market is something that a lot of people are intimidated with, but the fact is right now, the days are over when you can really just insist that just invest in your local currency, particularly those of us who are used to the dollar being king forever, and not really worry about foreign currency. Those days are over. Anyone who's stuck with the dollar through, from March '09 through the end of the year and needed to cash out that money, if they had a problem. And similarly, anyone in the euro who's been in the euro has suffered tremendously. Investors need to be aware of Forex markets, of commodity markets. More and more, they're affecting all the markets are getting more and more interrelated. We specialize in making it easy, in holding investors' hand, people who are new to it, taking anyone who's never heard of Forex or someone who's a sophisticated investor. We have 24-hour support, multiple languages, a variety of trading platforms they can use, and we will hold anyone's hand and get them up to speed with minimizing the risks there so that they can survive and prosper in what are very, very challenging times, and we're there to help them manage that change.
All right, well, thanks again, Cliff. I'm Christy Duffy for Smart Trend News. For more interviews, news, and stock market analysis, make sure you're subscribed to our YouTube channel, Trade the Trend, as well as checking out our website. That's tradethetrend.com.